This is a bottle of mouthwash. It's also been the benefactor of a number of pension funds, universities and religious institutions for nearly 141 years. When we bought this bottle of Listerine, a portion of its sale went towards the owners of royalties for the Listerine product. Or, put more accurately, approximately 6 cents went to these royalty holders. Royalties were first paid to kings and queens for the right to extract mineral deposits from the land they owned, hence the name royalties. Royalties are essentially payments made to owners of an asset by others wishing to use it. They're a bit of a secret in the finance world and have flown under the radar for decades, despite the fact that they're a pretty integral part of the global economy. Let's use Listerine mouthwash as an example. In 1881, Listerine was licensed in perpetuity to the holder of the patent, J.J. Lawrence. The license terms agreed that for every 144 bottles of Listerine sold, the holder of the royalty would receive $6. The Catholic Archdiocese of New York owned a 50% stake in Listerine royalties for nearly 2 decades, raking in $13 million over 16 years. You can even place bids on a share of royalties at auction. Here's one that sold in May for nearly $2 million, offering approximate annual revenue of $114,253. Not bad for a passive income stream. You might be able to see why these investments are so attractive. They provide timed income, often without an expiry date. They can also provide better returns if the underlying product sales increase. Imagine you're a biopharmaceutical company looking to find the cure to a life-threatening disease. You need financing to pay employees, rent laboratory space, and go through testing of the cure. In order to pay for these expenses, you have 2 traditional options. One option is debt financing, where you go to the bank and ask for a loan. But banks don't want to finance you because the odds of you getting to market with your product is incredibly low. Only 10% of drug candidates pass clinical trials. Alternatively, you can conduct an equity raising, selling shares in the company. But you don't really want to sell shares in your business to equity holders, as it brings in third parties that have influence over how things are run. Another option is to go outside of traditional financing via a royalty agreement. The buyer of a royalty agreement generally pays an upfront amount in exchange for a percentage of future sales in the product. In this example, a royalty buyer might help finance the development of the drug for a 20% cut of all sales in the future. So if the drug eventually comes to market, the royalty company receives regular income. There are companies that operate specifically with the intent of royalty financing or purchasing royalty agreements. These agreements all have rights to expected future cash flows. Royalty businesses have a number of unique characteristics that make them attractive for investors. For starters, they're not capital intensive and are less exposed to the operational risks of the companies their royalty payments are generated from, such as operating cost pressures, capital cost overruns, and a large workforce. In general, royalty economics are not diluted when debt or equity capital is raised. The royalty financing model is highly scalable from a workforce perspective, unlike adding multiple mining operations or manufacturing facilities for the development of a drug. Royalty agreements can also be tailored and can be applied across multiple industries. We can split royalties into 3 broad categories: royalties from mining, royalties from pharmaceutical, and royalties from music. For example, streaming giants Spotify and Apple Music pay out more than 2/3 of every dollar earned through streaming to companies that own the music copyrights. Buying and owning the intellectual property behind a song, whether it's the publishing, writing, or producing, gives owners like Warner and Universal Music the right to a percentage of revenue from each sale. The attractiveness of buying a music royalty becomes pretty apparent when you consider the correlation of recorded music revenues to traditional economic indicators. Take a look at this chart. Between 1998 and 2019, recorded music revenue tends to be less correlated to consumer spending than overall entertainment spending. Basically, if you're in a recession or a stock market crash or an oil boom, people still listen to music. We recently launched a royalty ETF, the first to offer investors exposure to a portfolio of global royalty companies from a variety of industries and sectors. You can find out more about the fund on our website. Thanks for watching. We hope you learned a little bit more about royalties. Please feel free to leave a comment or like and subscribe. See you next time.